So far here in Unit 5, Keynes has definitely been winning. We've been doing problems where the government shifts aggregate demand and it always works. And now it's time to hear from the other side. And to do that, we've got to go back to a graphic we did many weeks ago, the loanable funds market. Okay, and here it is. You see the graphic, the title right there at the top, loanable funds. As always, quantity, it'll be the quantity of funds that are being transacted. Real interest rate. Now that's important. That's the real rate of return if you're a saver, and it's the real interest rate you have to pay if you're a borrower. Now let's go back to real here just for a minute. Remember, anything real is when you take the nominal number and you squish the inflation out of it, because the inflation is sort of like air, all right? Analogy. I have this bag of chips, and I'm going to hold it upside down because I know it bothers some of you, and we're not in class where I can leave little stray marks on the board to really get your goat. Now, this is a pretty small bag of chips, but it's even smaller than it looks. Nominally, it's this big, but look, there's all this air here. So what I'm going to do is pop it open, and now let's look at the top. Look at all that air there. The real stuff is way down there. So anything real is nominal minus the air. All right, the inflation really doesn't count. I mean, sorry to be rude here, but it's just air, okay? The real part's down here. These are actually pretty good. So who's actually transacting in this market? Well, I'm going to start with the supply first. The suppliers in the loanable funds market are savers. What's a saver? A saver who is someone who takes their money and loans it to someone else in order to get interest. In a very basic way, you can put your money in a bank and get interest. That would be saving. That would be the S-curve here in loanable funds. Now, maybe you're buying bonds, government debt, or corporate debt. Maybe you're buying stocks. The point is you're not getting something from your money like a good or a service. You're saving it in order to get interest. Now, what motivates people to save? Well, high rates of return. So if we have a very high rate of return, we'd expect lots of saving. If we have a low rate of return, we would expect very low saving. So in a moment, you'll see the upward sloping supply curve. That's the S in loanable funds. All right, and there's supply. Now, who are the demanders? Well, in the loanable funds graph, demanders are investors. Now, when we say investors, remember in AP Macro, we mean a group that's very specific. Investors are people who want to buy capital. Could be you getting a student loan to buy your human capital, or it could be a business getting a loan to expand its plant capacity. But the point is, investor equals someone who wants to buy capital. Now, obviously, the price of borrowing that money is going to affect their decision. If it's a very high rate of interest, fewer people will be willing to borrow. As the interest rate comes down, we would expect more and more people to borrow. So let's put the demand curve in right now. For loanable funds. Now, here's the very important part about this graphic. When this rate is attractive, i.e. low, it means lots of people will invest, whether it's you or businesses. Now, that also is going to affect ADAS by moving the Larousse curve to the right. That's right, that almost impossible thing to do comes when we have more capital. You have more skills, businesses have more technology, whatever. When we have lower real interest rates, more economic growth, Larousse will go to the right. Now, conversely, when we have higher real interest rates, that's going to choke off investment. That's going to hurt long-term economic growth. So where's the counter-argument here to Keynes? Well, it happens when the government spends money it doesn't have. Now, of course, they could increase government spending in a recession and raise taxes commensurately, but of course that's going to choke off some of that gain. So what if they just simply borrow the money? Where do they borrow it from? The loanable funds market. So when the government has to borrow money because it's engaging in some sort of fiscal policy, they're going to shift up the demand curve. Now, what's the problem with this? Well, they've just raised the real interest rate, which was what we just said can't happen if we want long-term economic growth. So ironically, the government trying to fix the economy in the short run with their extra spending does shift up aggregate demand. But then it raises real interest rates, which is going to knock economic growth back down. Now, this very important phenomenon is called crowding out. And in a nutshell, what it means is government spends money through borrowing, and that crowds out private investment. So we don't get the long-term economic growth that we wanted. And this is how you would show it with the Lone Wolf Funds. The best news in this case is you won't be asked to calculate the crowding out effect. Usually you'll just be shown on the Lone Wolf Funds graphic. Now the way it may be phrased with an ADAS question is the government's going to spend money, there's no crowding out. Well, that means you just multiply it by the multiplier. Now perhaps they could say, but there is some crowding out, therefore that would be the most it could grow. But obviously it might be less, again, because the government has raised interest rates and hurt long-term economic growth.